I believe in the discipline of mastering the best that other people have ever figured out. I don't believe in just sitting down and trying to make it all up yourself. Nobody's that smart. Charlie Munger. Have you ever wondered why only a few people in the world have more wealth than billions? What do they think? What are their investing principles? What sort of advice have they taken in their lives that has made them multi-billionaires? To answer all these queries, we need to take a deep look into the investment principles of Charlie Munger to learn how you can also change your investment habits and make sure that such habits help you grow quickly in the future. Hello 101 community, welcome back to our YouTube channel. In this video, we will explain 4 principles of investment by Charlie Munger. But before we begin, if you are new here, make sure to subscribe to our channel and turn on notifications to never miss any updates. Now, let's start with the video. What is the background of Charlie Munger? Munger had a very strong academic background, attending Caltech to study meteorology during World War II, going on to attend Harvard Law and establishing his own firm in the process. His achievements in that field make sense. Even though it might seem surprising, he did in fact never study any of these subjects. However, despite this lack of education, he managed to become one of the most famous, admired, and honorable people within the sphere of economics. Almost everyone who observed him recognized how creative his ideas were, particularly when it came to business and human behavior. That is not something you learn about in Harvard Law School or anywhere else. He is truly the broadest thinker I have ever encountered, Bill Gates said about him. In other words, according to his business partner Warren Buffett, he comes ready for rationality. In my opinion, no one would fit Charlie if I tried to compare him to any other person I can think of. He follows his own model. Buffett and Munger's management of Berkshire Hathaway has led to possibly the most astounding prolonged performance for investors ever seen. The stock has increased at an average rate of 20.1% since they started running Berkshire in 1965. During the same period, the annualized return for the S&P 500 was 10.5%. The rise in book value has also greatly outpaced the increase in the S&P 500, which may be used as an approximate proxy for the growth of the company's intrinsic worth. His 4 principles of investing are: Number 1. Avoid making dumb mistakes instead of trying to be smart. Most investors attempt to beat the market in order to increase their profits, but this is typically a fool's errand. After all, some of the world's smartest individuals struggle to succeed when working on Wall Street, where they have access to seemingly limitless resources. But according to Charlie Munger, avoiding foolish mistakes is more important for investing success than being extremely brilliant. He says it is surprising how much long-term advantage people like us have received by attempting to be consistently not stupid instead of being highly intelligent. One of the few places where you can consistently outperform the norm by making rational, average judgments over a lengthy period of time is the stock market. You merely need to avoid mistakes, especially during a down market, so you don't need to be a genius. Long-term returns will be outstanding if you can avoid mistakes like selling stocks at the bottom of the market, chasing buzz stocks without doing your research, or attempting to time the market. Number 2. The quality of the business is more important than the price. In a speech he gave in 1994 at the Marshall School of Business of the University of Southern California, Munger stated, "It's challenging for a stock to generate a higher long-term return than the company that supports it. Even if you first purchase the business at a steep discount, you won't get much more than a 6% return if the business makes 6% on capital over a 40-year period while you own it. Conversely, even if you pay an expensive-looking price, you'll get one heck of a result if a corporation earns 18% on capital over a 20 or 30-year period." It's easy to become unduly focused on the fair value price while ignoring the quality of the underlying asset, given that the market has recently punished stocks with high price tags. Apple is the ideal illustration of this. Despite rarely trading at a cheap price, the computer giant has consistently paid investors handsomely over the years, in large part because of its outstanding return on invested capital, ROIC, which has been averaging about 20% for more than 10 years. Stock prices are important, but they must be considered in the context of other performance indicators like ROIC. Low ROIC companies that are inexpensive will probably underperform high ROIC firms that are pricey. Keep in mind that a low price does not always translate into a smart purchase. Stocks frequently trade at a discount for a good reason. If you liked the video so far, press the like button and subscribe to the channel. Also, if you want to develop yourself financially and want to take your future into your own hands, check the links in the video description. You can also support the channel by visiting our merch shop and buying one of our products. The link is also in the description. Let's continue with the video. Number 3. To a point, diversification is beneficial. Another insightful statement by Munger is that the idea of excessive variety is folly. Diversification is a difficult concept to understand. The majority of us tend to view it as a generally beneficial habit. Don't misunderstand me, it's crucial for effective investing. Nevertheless, diversifying too much has its risks. It gets more difficult to keep track of your equities as you add more to your portfolio. You also reduce your potential upside, eventually achieving market average returns. You would likely be better off foregoing individual stocks and investing in inexpensive index funds if your risk tolerance necessitates having hundreds of stocks in your portfolio in order to feel secure. One of the cornerstones of long-term investment is still diversifying your portfolio, but Munger is cautioning against adopting over-diversification as a crutch. You shouldn't just acquire lots of stocks to avoid learning about the businesses you own. Number 4. Focus on the micro instead of the macro. Charlie Munger and Warren Buffett have both repeatedly indicated that they are not interested in basing their investing choices on the macroeconomic climate. Numerous comments similar to this one from Munger have been made over the years. Gigantic macroeconomic projections are something I've never made any money on, and neither has Warren. The macroeconomic environment is extremely unpredictable and subject to sudden changes. Even the most talented economists in the world frequently mispredict the future. This was the conclusion reached even by the International Monetary Fund, IMF, in a 2008 study on the accuracy of economists' recession predictions, which found out the predictions were, by a substantial margin, off. However, outstanding enterprises will continue to operate at a high level and, in the long run, return rewards to investors regardless of macroeconomic conditions. Long-term success will be much enhanced if you can merely avoid major blunders like excessive diversification, putting all of your attention on pricing, or timing the market to coincide with the macroeconomy. These 4 Mungerisms are wise counsel for all market conditions, but they are particularly pertinent at the moment, given that investors frequently make grave mistakes when the market is negative. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you will be notified of every update. Also, don't forget to check the links in the video description. Remember, we live in turbulent times. The global economy is upside down, and we have made it our personal goal to deliver financial education to everyone. Watch our video appearing on the screen right now. See you there.